We are going to get started after a few more people have joined. But for now, I'm going to go ahead and introduce our presenters. So, hello, my name is Darla Shaler. I'm the marketing coordinator here at Lane Gorman Trubitt, and I want to welcome you to today's webinar. For those of you joining for the first time today, Lane Gorman Trubitt is a mid-sized accounting firm for all business sizes. LGT Financial Advisors is an affiliate company of LGT. LGT FA provides its clients a continuous, personal, and comprehensive holistic wealth planning approach that includes planning through financial, investment, retirement, legacy, protection, cash flow, and tax strategies. The firm believes a trusted advisor is to align to our clients' plan with their values and goals in mind. We believe thorough, continuous planning creates an exceedingly beneficial relationship between wealth and well-being. And this is Miller Bentley on the top for me. Miller is a senior financial advisor with LGT Financial Advisors and is passionate about helping clients achieve their personal and wealth goals. Miller holds the Series 65 license along with the life and health insurance license. Miller typically assists small business owners and high net worth individuals with the many facets of wealth management. Miller also leads LGT's retirement planning groups that helps businesses navigate and efficiently run retirement plans for small and medium-sized businesses. Josh is also a senior financial advisor with LGT Financial Advisors and has over 13 years of experience in the wealth management industry. Josh holds his certified financial planner designation along with a Series 65 license and life and health insurance license. Prior to LGT, Josh held positions as a planner and advisor at TD Ameritrade, now Charles Schwab. As a senior financial advisor, Josh focuses on helping clients develop comprehensive financial plans and coaching them through the wealth management process. So without further ado, y'all take it away.
Thank you, Darla. So I'm Josh Orton, like Darla mentioned, joined here with Miller Bentley. And today we're talking about planning for a prosperous future. Really what that means to us is planning for a comprehensive financial plan that really encompasses all of your goals and really what you've worked your entire life to achieve. And so this is really exciting for us. We kind of view this as us rolling our sleeves up and digging into some finer details of what we really are passionate about sharing with our clients. And we're really excited today. And there's our two faces there, but there's also our contact information there. And before we get too far, quick disclaimer. It's there on screen. Take a picture if you want to read it. We're not going to spend any more time on it, but just know that nothing that we talk about constitutes personalized investment advice for you. If you want that, you need to contact us, and all investments involve the risk of loss. So on the next slide, again, that's our contact information. Questions, phone number is right there. Our email is right there. Our website is there. So we encourage you, if you like anything that you hear and want to learn more, if you have any questions, give us a buzz or shoot us an email. We're happy to help you out. And Miller, why don't you talk us through what's in store today? What's on the agenda?
Absolutely. Thank you, Darla and Josh. Great to be here and go over some broad topics here. And we're kind of touching on everything today. You might hear us say it a few times, but we can dive into these topics really in depth, and we could spend hours talking about each of them and how they affect your individual strategy and your situation. But we're touching on a lot of stuff here today, going through retirement planning, what encompasses retirement planning, getting into some investment management, cash flow, estate planning, how that all ties together with your wealth, tax planning. Obviously, the Uncle Sam is going to be a big part of your overall wealth picture, and then into some planning for your own business. So privately held businesses or closely held companies that you've worked a long time for to start or manage or acquire, how to effectively transition those into a prosperous future in its own right. So when we kind of take all of these different topics, there's a few different puzzle pieces to the overall wealth management process, and individually they can look a little bit categorically out of place or whatnot, but it does take all of those and they all weave together and create your overall wealth plan. And so what we do at LGT Financial Advisors is connecting all of those dots and making sure that the investments align with the estate plan, which align with your risk planning, which overall align with your retirement planning. So while we'll touch on all of these, there isn't one individual subset that is more important than the next necessarily. It's really how those apply to you and how they can be most impactful on the success of your plan. So our first topic here is retirement planning, and we're going to have Josh talk to us a little bit about that.
Yeah, thank you, Miller. So retirement planning and really all of the planning that we're talking about today, I would kind of view this through the lens of, we're trying to impart as much wisdom and context as we can. But at the end of the day, this is kind of like the classroom. If you want to really get in deep and step into the lab, you need to contact us and we can look at your personal situation a little bit further. But retirement planning and all planning that we do, it starts with defining what your goals are. And your goals, it's just more than how much money can I accumulate, but it's also where do you want to spend your time? Who or what are you working for? At what points in time do you want to do the things that you want to do? So, it's one thing to just say, I want to retire. It's another thing to say, I want to retire on this date when I'm 65 or on this date when I'm 67. So defining that one goal within the context of retirement planning is important, but think of all the other things that you can do. Well, I want to travel more. I want to spend more time with my family. I want to experience new things and see the world, or I want to work part-time, whatever it is that you want to do. And it's important that we establish what those are kind of at the beginning of the planning, so that we can incorporate those into your overall retirement plan and your overall wealth plan. So as important as it is to establish timelines, it's just as important as it is to establish dollar amounts to all of these. And some of the things that we look at when we're putting together a retirement plan, this first thing here that we'll look at is income replacement. And what I mean by that is how much of your pre-tax income do you need to replace in retirement? Well, if you do any amount of searching on the internet, the general rule of thumb you'll see is about 80%, but that's not always right for everyone. You can see it on here on the screen. If you have $40,000 a year in pre-retirement income there, that replaces 66%. So right at about 2/3 of your just income pre-retirement is going to be replaced by Social Security. That bottom line 30% that's in blue down there on that bar, that is just from other sources, other saving sources. But overall, what you get at the very top line, it says 96%. That would seem to me to indicate that about 96% of your pre-retirement income, you need to find where that money is coming from in retirement. So, that those numbers change as you have higher and higher income. Look at someone who earns $200,000 a year pre-retirement. Social Security is replacing about 25% of their pre-retirement income. And if the total overall it says 76%, well, you bet that other 51% is going to need to come from somewhere else. And so that's really where we get creative in the things that we can do. And let's go ahead and look a little bit further on the next slide at Social Security. Miller, can you give us a quick, what can we expect and what's in store with Social Security?
Yeah, absolutely. So when most folks envision retirement, Social Security is usually the second thought right there as far as what we're going to do with income. Social Security was created out of the Old Age Survivors and Disability Insurance Act in 1939. And you can see there in the chart on the right, at the time in 1940, the life expectancy was at birth for males 61.4 years, for females 65.7 years. If you reached that age and you were at age 65 in 1940, on average for a male, they had about 12 more years, and a female had about 13 and a half more years to live. So you can see here where at the time, the trust of Social Security, of what it was created for, really was only paying out benefits for, on average, less than 15 years for folks. So you can see now that how that has progressed over the years, where now for males, average life expectancy almost 78 years old. Females, it's gone up almost 82 years old, and then dramatic increases at the age of 65 with how many years more you are expected to live on average past age 65. So as the life expectancy has grown, as has Social Security and those payments. The eligible claiming age for Social Security is anywhere between age 62 and 70, depending on the year that you were born. Now, that doesn't necessarily mean that is your full retirement age, but it is when you are eligible to start claiming those Social Security benefits that you've been paying into every year. But the main thing to focus on here is kind of that average benefit that was paid out. And this is as of August of this year. The average monthly benefit that was paid out, now this is per month, was just under right at $1,700, $1,705.79. So that is an average, obviously, but take just a quick thought about the amount of income that you are currently making, and especially if you are near retirement, what $1,700 per month would do and how that would impact your income in retirement. For most folks, that's going to be pretty well short of your everyday needs month to month. So while Social Security isn't necessarily, the end all be all, there are definitely some planning techniques that need to be taken advantage of and some extra savings that need to be done in order to supplement your loss of income from a job, and also with Social Security making up the difference there in how you're going to take care of those everyday expenses in retirement.
Yeah, thank you, Miller. So yeah, you could see just how important it is, Social Security going forward. I want to take you to the other part of that bar graph that we showed you, which was that blue section, which was just kind of everything else. So some common withdrawal strategies, pre-tax versus post-tax, taking a targeted percentage of your assets. I'll get into both of those, but almost as important is the timing of your distributions. And you can imagine just how important it is. All right, if I have to take 20 years worth of distributions because I retired earlier versus 10 years worth of distributions because I retired later. We don't know those answers when you go into retirement, but we can plan for that sort of longevity risk that goes on with your assets as you get older in life. And here on the next screen, so think of, I'll describe these three buckets here, but this is kind of the traditional or a conventional way of thinking, which is I'm going to start with three buckets of income, or three buckets of assets, excuse me. The first one being taxable. So taxable account would be like your brokerage account, your investment account, mutual funds, savings accounts, just things that are non-retirement accounts where you get taxed every year along the way. Tax deferred, it is what it sounds like. These are your common retirement accounts, your 401ks, 403bs, IRAs. And then that tax exempt bucket would be like Roth IRAs, Roth 401ks, or some health savings accounts are treated like that. Well, the traditional method of going through those in order, look at that estimated tax bill, almost $60,000. An alternative way of doing that is looking at a percentage of assets from each of those buckets and taking them proportionally. So you're not drawing down one bucket and then moving on to the next one. You're drawing them all down at the same time. And just that diversification in taxation versus not being diversified and taking them in order, I mean, that's a 36% estimated reduction in taxes. So you can see the benefits there of doing it proportionally. So just as important as diversification of your investments, how about diversification of your taxability or taxation on your accounts? But let's look at here. We're really talking about is RMDs, and those are required minimum distributions for those that don't know. And I'll do a little trivia for you. think to yourself, do you know what age required minimum distributions start? And if you're thinking to yourself, all right, at 70 and a half, well, you're about 3 or 4 years too late. It's not that anymore. If you're thinking 72, well, you're 1 or 2 years late. It's not 72 anymore. It's actually 73. And then here in another decade or so, it'll be 75. But on top of that, if you're still working and you're actively contributing into your 401k and you're 75 still working, you can put those RMDs off. So there's a lot of this type of planning and conversations that we have that we can get around some of these things and just come up with a really solid plan. But required minimum distributions, yeah, it's based off your life expectancy. There is a nice little factor. You'll divide your account balance by that number, and that's your required minimum distribution. So there's the little schedule I was talking about, 70 and a half, 72, 73. Here on the next slide, we'll talk a little bit more in depth about insurance. So your insurance goes away when you retire. If you're after 65, you get what we're talking about here, Medicare. If you're before 65, well, you're kind of on your own there to find your own insurance on the marketplace. But Medicare is really, really big and important piece for individuals over the age of 65. Original Medicare has Part A, which I've always told people, that's when you're in a hospital. Part B is outpatient, going to see your doctor, your physician, things like that. So, and there's also Part C, Medicare Advantage plan, which kind of bundles Part A and B together, and they can include Part D, which is prescription drug insurance. But Medicare Advantage plans were specifically created because of the rising cost of insurance and Medicare. People who are retirees, some of them maybe not tremendously well off, or maybe they don't have a ton of extra disposable income. But just think about all of the extra expenses that go in life as you get older and older, and your income maybe is not able to keep up. Well, that's where Medicare Advantage plans were created. So there is an alternative, a Medicare supplement, which usually you'll have higher limits of coverage. So that's a benefit if you are someone who has chronic health issues or things along those lines. But so there is definitely planning that goes into that, which one to select, what to include, what not. Do you need dental insurance? Do you need vision insurance? Do you need, specialized insurance for cancer or some of the other types of really debilitating diseases? So as people go into retirement, these are often times where we're having conversations with those people about those. But we'll talk here just real quick about long-term care insurance next. So long-term care insurance, this is basically, all right, I need assistance with the activities of daily living. And the government was so kind enough as to define what activities of daily living are. They're things like eating, transferring, toileting, continence, dressing yourself, bathing. If you need assistance with those as you're older in life and you need some sort of long-term care or nursing care, that's where this sort of insurance comes in. And I've always told my clients there's a sweet spot where it's really, really beneficial, and when it's affordable as well, because really it's always beneficial. But think about the cost. If you were in your 20s and you're thinking about long-term care insurance, I might applaud you, but I also might say, hey, you're kind of spinning your wheels here in the mud. But when people get into their 60s and 70s and start thinking about it, well, then it's almost too late. Those premiums on that type of insurance are going to be really, really expensive. So whether that's a standalone long-term care insurance policy or it's a long-term care bucket of money that we're setting aside, it's really important that we build that into your retirement plan. The providers of unpaid elder care, oftentimes it's your adult child. You'll see your spouse to the far right of that top bar graph at 7%. Well, odds are if you need help living, your spouse does too, if they're still around. The next to that, the duration of paid care once you're over 65. if you're getting assistance just to live, well, most people, I think the stats show that women still live further and longer into those situations than men do. I think that's reflected there in some of the numbers. But yeah, it's incredibly important that we impart onto our clients just exactly how impactful this could be, and that we have a plan set up. And this it's not something where I just want to throw facts at you. I just want us really to start thinking about these sort of things as we get closer to retirement. You'll see lifetime care, that bottom graph there, lifetime cost of care if paid care is used. Well, unfortunately, that number is going down until you get to the far right, because fewer and fewer people can afford it. It's one of those things. If you can afford long-term care, you're in that very right over $250,000 bar. So it's an incredibly important aspect of your financial plan. We'll help you incorporate when it's appropriate. And the last thing I'll talk about with this, with insurance, is life insurance. It's actually caring for those that you love after you pass away. Just a quick terminology here. You'll hear the word term insurance. Well, that is exactly what it sounds like. It's insurance on your life that lasts for a specific period of time. So think 10 years, 20 years, 30 years. It's typically far more affordable than whole life insurance, which lasts for your whole life. They're not very creative with these terminologies, but if you are still living at the end of that 10, 20, 30-year period, nothing happens. You were covered for that entire time. You felt safe, you felt good, protected, but nothing happens. If there's a death benefit and you were to pass away in that period, then that would be passed on, generally tax-free, to your beneficiaries. But there's nothing else. There's no cash value like there is with whole life insurance. So on this next slide, I'll just contrast that real quick with whole life insurance. That's permanent coverage for the rest of your life. Like I said, far more expensive than term insurance, because odds are, if you have this, well, if you have it for your whole life, eventually, unfortunately, you're going to die. And that is when the death benefit will pay out to your beneficiary. And because of that, there is a little cash value component to that, which can be, it depends on exactly what type of policy you're in, but you do have the ability to receive dividends and to take loans from that and withdraw that. So we just like educating people up front and having those conversations as we go along. So Miller, I think you're back. Can you talk to us about investment management?
Absolutely. Yeah, thank you, Josh. So obviously those two topics being very paramount for retirement planning, getting into a little bit more of maybe what people would consider the fun part of financial planning, the investments here. There's at a high level, there's an incredible amount of investment types of what you can actually buy and invest in and help your money grow, rather than just earning an income and using that organic growth of your income to save. You can actually then put your money to work and have it grow for you. Now, there's very different levels to those investments. Three listed here: common stock. You think of your Apples, your Tesla, your Amazon, Berkshire Hathaway. There's some that folks key into that make sure that they are knowing what they're investing in. So publicly traded company, traded on an exchange. Bonds are, on the flip side of that, debt securities that are issued. So you can actually buy the debt of a company, or in this case, you see three examples there: a municipality, a corporation, or just the U.S. Treasury, where they will issue a bond that has a specific backing entity. You can see there the differences on those backing entities, a specific coupon. So as you are assuming that debt, you get paid an interest rate for holding that. And then there is a maturity period there where at the end of the day, you receive your principal back along with any payments of those interests due at the same time. Similarly, a CD, a certificate of deposit issued by a bank. These can be FDIC insured. They have a specific coupon or a yield associated with them and a specific maturity on how long that interest rate actually takes place. And getting into a little bit more of the specifics here, the next two, mutual funds and exchange traded funds, what those are simply package deals of those common stocks and bonds. For mutual funds, they are really across the board a various types of strategies and package deals that are put together so that an investor doesn't have to go out and find and buy all these specific companies' stocks to purchase, but they can go in and purchase one singular mutual fund or product to achieve that goal. You can see there some examples: the S&P 500 index fund produced by Schwab, or a select energy portfolio that is managed by Fidelity. And then what most people are used to in their retirement plan is a target date retirement fund that has a specific year. So that means that as the year approaches that is specified on the fund, in this case 2055, the investment becomes less and less risky, so that it's putting less and less capital at risk of loss as you get to that year of retirement. Exchange traded funds act in a similar nature to mutual funds in that they're a package deal that you can purchase on an exchange. Exchange traded funds are typically more focused on an index. So you'll see there the Vanguard 500 index fund. So what that means is you can have for as little as I'm not sure that there is an actual minimum investment on this mutual fund. But you could say, I'm going to use $5 or $10 to purchase this ETF that has exposure to all 500 stocks that trade on the S&P 500 index. There also are, similar to mutual funds, those sector-specific investments, self-driving EV and tech ETF there you can see as a second example. Derivatives and alternative investments, those are really getting into the more high level and sophisticated investments, not necessarily saying that they have all these great promised returns and track records and everything. It's just a different way of investing. And you can see on the right there kind of the hierarchy. While some of these can be moved up and down, maybe depending on the amount and what specifically the backing entity is. But you can see there options, futures, collectibles. Those alternative investments are typically on the highest risk scale. And then going down from there, we have large equity mutual funds, real estate, even high income bonds are kind of in that middle category. And then they're at the very lowest risk, typically US government issued debt, money market funds, CDs, things that have backing entities behind them that can assure that if something were to happen, if something were to fail, that those debts can be paid off to the note holder. You'll see here that pinpointing one specific asset class to be the one place that you're going to invest in and let that ride for until you're retired, that's an extremely difficult ask here. You can see, just looking across this quilt chart here, the different asset classes and how they've performed over the past 10 years. And you can see that top line isn't necessarily always that high of a number. You can see in 2018, the highest return on your investment actually came from cash. So that was only up 1.9%, and every asset class then performed worse. You can see there, even similar as in 2022, cash was the second best performing at 1.3%. But then you try to find cash on that quilt chart in other instances, say in 2014, that cash earned you 0.1%. But if you were invested in real estate investment trusts, you would have been up 22.8%. So what this shows us is there's not necessarily a specific one asset class to hone in on and invest in, but being diversified across them can typically help mitigate your risk and enhance that opportunity for growth long term. Now, all this talk about investments, it really comes down to what you need. What are you looking for and what fits your plan? We typically use the financial plan as the roadmap. And investments are typically, you can view them as the car. That's how you get to your goals. Now, it depends on what kind of car you actually need to help you get there in the safest, easiest, and most effective way. And along the way, are there any things that you want to invest in specifically or not invest in specifically? What's your time horizon? Investing with purpose can be very powerful. Again, we get back to prioritizing goals. What are we saving for? Is this a short-term goal, looking for, maybe purchasing a new house, paying for an education expense, maybe a medium-term goal, and longer-term goals, obviously being retirement, funding grandchildren's education potentially, and looking at how those assets need to grow and when you need to use them. This gets us to two types of risk that we usually analyze. Risk preference, which is an individual's willingness to even take risk. So even if something might make sense on the plan, if you're not willing to put a certain amount at risk, then that might not be the best option. And similarly, risk capacity being your ability to even take risk relative to your goals, and making sure that we're keeping that risk in check so that you're achieving those goals as best as possible. These three items here, implementing, benchmarking, and rebalancing, are keys to a successful asset allocation and portfolio growth. Implementing, pretty standard, putting your plan into action, actually making those investments. Benchmarking is the next, which is an ongoing process. Benchmarking, it's taking your plan and saying, am I actually on track here? Or is something off where we need to make a correction? So on this chart on the right, you can see really those last two sections there are very important. Measuring your own portfolio and assets that you've selected against other assets in the similar buckets, and then measuring your portfolio against what you want to actually happen. So ensuring that you're consistently at least, benchmarking your overall portfolio to a specific and pre-specified selection for securities and also goals of your own. And then the third thing there being rebalancing, but staying within your targeted allocation and being able to tax loss harvest when it's appropriate. So what we mean by this isn't necessarily rebalancing and saying, well, the markets went down 20%, and so I need to sell out and wait until the markets rebound again before I'm comfortable with buying in. That's not following your plan. What rebalancing is saying is, my overall objective is to have my portfolio in this specific amount of equity investments and this specific amount of bond investments, this specific amount of cash, and then making sure that you're staying within those boundaries. Every once in a while, your assets might fluctuate and get out of balance there. So it's always good to rebalance and get that back into your targeted goal. Now you'll see on the right there, that's just to improvise and emphasize the need to stay invested and not necessarily selling and staying out of the market and making emotional decisions, but rebalancing within your targeted agenda. You can see that what this shows is that over a 20-year period here, that if you were fully invested the full time in the S&P 500 index, you would achieve about a 9.8% annual return. But if you missed even just 10 of those trading days and you were out of the market for 10 of the best trading days over that 20-year period, your returns would essentially be cut in half to about 5.6%. And the same thing goes on that step up to even missing 20 of the best trading days. Now, I know the answer to this, Josh, but there's no way to predict when these best days will be. And similarly, there's no way to predict when the worst days will be. So we always emphasize long-term strategies and staying invested so that you're not missing out on any opportunity for growth. because if we do, it can be extremely detrimental to the overall plan. So Josh, I'm going to turn it over to you here to talk a little bit about planning for your small business.
That's right. So this is planning for your own business that you own. And let's be honest, when people get into business and they start their own business or purchase into a business and become a partner, what they're really eventually doing is talking about what does their exit from this business look like. So in addition to controlling the company and growing earnings and revenue, all of those, and the business value, growing that's all important. Eventually it comes to a point where, all right, I need to exit this business in a way that makes sense for me. And so we put on here, of course, you're exiting your business, this one-time event, planning for that, but it requires annual and sometimes more frequently than that attention. But we'll start on the basics, just like we do with your personal financial plans. We identify your goals and your company goals. So a goal of yours may be, all right, I know the exact person I want to sell my business to, whether it's a third party or someone in your family or a key executive. You know exactly what that looks like. But also you have an idea in mind of, all right, do I want this to look like a lump sum payment to me or annual installments, like an annuity payment to me? What does that look like? But then also look at the company itself. The company still needs the infrastructure and people in place to continue to operate. So you building your own business up, you hand it off to the right people to ensure that your customers and your clients are continued to be taken care of. That's extremely important. You don't want to just hand the keys over to someone else and then within a year or two, things fall apart. So whether that's someone within your family, a key employee, or someone that's a third party, it's important to focus on what do you want this to look like, both at your exit and after your exit. And some common pitfalls that we see when doing this sort of planning, just a general lack of communication with employees, other business partners, or other owners, not having a formalized or adopted agreement, and just kind of in general making assumptions. The assumption of I'm going to be around for another 10 or 15 years. I'll worry about this later. Or, I have a feeling that my kid is going to take over. I think that he or she will do a good job. But the time comes and they say, whoa, I don't want to be involved in the business. I have other things going on. So thinking of those things before they happen, obviously, is very important. It's things that we can plan on and building up your next generation of leaders. But here on the next slide, you'll see a couple of really common succession planning strategies. Things like employee stock ownership plans, where you sell your stock in the company to the employee stock ownership plan trust. The company buys those from you, and then there's your cash. So the company effectively buys you out and allocates the remaining shares on a non-discriminatory basis to your employees. So it's you getting what you want, which is out, and probably your other employees or partners getting what they want, which is more ownership in the company. Key person insurance is less about exiting the business, but more about just making sure you have the proper insurance and protection in place in case you or someone else that's really important to your business passes away or becomes disabled. If you have someone that drives a majority of your sales and revenue, what if they died prematurely? That would be pretty detrimental to your business. So having the proper insurance in place is really important. Not really ideal to rely on fully for some of the more complex businesses, but definitely can be a component of your business planning. And then a cross purchase agreement. Well, if business owner A and business owner B own a company here, well, I'm going to buy insurance on business owner B, and business owner B will buy life insurance on me, business owner A. So if one of us passes away, our beneficiaries, they receive our share of the company, but they can turn right around with the cash they get from that insurance policy and buy and buy out. And what this really is looking for is In that situation, someone passes away. Well, we want one owner left that controls everything. And the only way that's going to happen is if the you, as the owner of the company and the owner of the insurance policy, you receive that cash and are able to buy out the beneficiaries of their share of your company. So that's what that looks like. Really, we can spend hours more on this, but that's a quick summation there. On the next slide, we'll talk about just business retirement planning in general. So when you are the owner of a business, it's a little bit different than when you are an employee of a large corporation. So if you're an employee of a large corporation, maybe you have a 401k plan or a cash balance plan or a pension. Well, when you're the owner of the company, you get to make decisions about what type of retirement plan you get and one that you're going to establish. And so we'll illustrate a couple here, but this comes back to what's your goals? I mean, what are your goals? Do you want to make sure that your employees have the proper account type to be able to save as much as they can, and you want to match what their contributions are? Or is this more about you, or, hey, I have fewer employees to worry about, and I'm a little bit closer to retirement, so tell me just how much can I stash away in retirement? What's the best retirement plan for me? This is exactly what we're getting at. So look here on the far left, someone who maybe says, I don't have the cash flow to make that big of a 401k contribution, but I would like to set up a plan for me, and I'm thinking of a SEP or a simple IRA. Well, it's not that hard to see which bar is higher. We look towards a simple IRA. But look at the far right here. If you're asking us, what's the most amount of money I can stash away? What account type is that? Well, we would lean towards either a SEP IRA or a 401k plan. But keep in mind, those 401k plans can be costly, and you need an administrator to administer those plans. So those are some of the conversations we have about setting up the proper retirement plan. And to drill that home, we'll look at the next slide here. It's less about learning the exact dollar amount and percentages that can go into all of these. I mean, we're happy to have the conversation with you, but just look at the assumption: someone that's making $330,000 and they're in the 37% tax bracket. Well, with no plan whatsoever, you can only contribute to an IRA, and that means you can only stash away $6,500, and there's your federal tax savings, $2,400. We can talk about implementing a 401k with the safe harbor, or implementing a 401k with a profit sharing, or doing both of those and adding in a cash balance pension plan. And just look what that does to that top number on each of these bars. What's your total deferral that you can stash away? And then right below that, what's your combined tax savings? So look at that far right. This person can stash away $300,000. They could potentially save $111,000, but they can't discriminate really on their employees. And so you'll see they'll have to contribute 10 to 15% to all eligible staff employees. So really, it's a yin and a yang. For as much as you want to stash away for yourself, you might have to do the same for your employees. So doing some minor planning on that is really important as well. Miller, what can you tell us about cash flow planning?
Yeah, those retirement plans can get really intricate. That's definitely something that we work with. I'd say day in and day out is helping small business owners, small medium business owners just figure out what their goals are and what plan works best for them. So big emphasis there on the retirement plans. Cash flow planning is just the foundational of retirement planning, and we try to emphasize this and get ahead of it here at the beginning because you'll see that there is a large benefit to saving early and saving often versus trying to catch up later on in life. So a general rule of thumb here of what we typically keep in mind is the 50-15-5 rule. So what that means is when we break it down from looking at your income and what comes in the door and how that money gets spent each month or each year, is 50% of your take-home pay goes to your essential expenses: housing, paying your mortgage, paying your rent, keeping your food, keeping your roof over your head, and then I was getting ahead of myself there. Food, groceries only being that, included in essentials, healthcare. Essentially, what does it take for you to do the kind of the bare minimum in life? So take 50% of that take home pay and allocate it to those payments. 15% of your pre-tax income should be going to a retirement plan. Now, hopefully that is a group retirement plan that you have set up through work, and hopefully they offer some type of profit sharing or match that they can increase your contributions just through their matching. But at any rate, about 15% going to retirement savings. And then 5% of your take home pay going to short term savings. And what we mean by short term savings is really an emergency fund, or some people call it a rainy day fund, but really it's a fund that is used to offset any unforeseen expenses and mainly to be a safety net there if in the case of you actually, in worst case, losing your employment. So for single, if you're single, we typically recommend about 6 months worth of income saved up in a short-term savings account. If you're married, anywhere from 3 to 6 months. The reason being that the difference is there. If you're married, typically there is a second source of income that you can rely on for a shorter amount of time. And it also depends on what sector or industry you actually work in. If it is a stagnant job market, or if it's somewhat tough to move around or find, if you're at a level where it would be difficult to find a new job, well, we might increase that short-term savings account for a little bit more. So 5% is typically just a steady trickle to start building that account up in short-term savings. So then the remaining 30% or so is your choice. That's your non-essentials. That's your entertainment. That's enjoying life here with using that 30%. Now, it is your choice, kind of. Now, what we mean by that is typically we lead this right into a conversation about debt. And there is good debt and there is bad debt. Typically, good debt is going to it's going to increase your net worth, and it is typically lower on the interest rate scale. So think of your mortgage, think of student loans, even a real estate investment property. That is debt that is going to increase your overall net worth and help you in the long run. Now, bad debt is usually comes in place when we're maybe running into a predicament. It's usually a very high interest rate, and usually it's unnecessary. And maybe it's because we've done some poor planning or budgeting, or expenses have gotten out of hand over the past few months. But that is not going to add to your overall net worth. And usually those high interest rate kind of bad debt looks like credit card payments, maybe a payday loan or a personal loan that really is detrimental. So we usually recommend with that 30% to, rather than spending it on yourself and going out and going to the casino or whatnot, to start pecking away at that bad debt first and take those high interest rate loans and get those down to zero as fast as possible. And so you can get to enjoying life without as much debt on your shoulders. And then when we look at cash flow planning, we can tie that into retirement planning and how much you really need for retirement. There's a lot of different ways to do this, but two simplistic ways to look at it is how quickly, or what do I need to do to get to $1 million at retirement? And when we say retirement, that is, for this case, age 65. So you can see there, if you started saving at age 20, you would save $361 every month and put that into an account that could return 6% on average per year. And if you did that until you were age 65, well, then that's when you would end up with $1 million, $360 per month in savings. Seems pretty manageable. Well, let's say you waited until age 45. Then you'd have to be saving $2,100 per month just for retirement. And you can see there the big difference between starting at age 50 and age 60. That increases exponentially. just to get up to that target of $1 million with a 6% growth rate, which isn't too bad. The other way to look at it is saving as much as possible as early as possible, and then letting that compound and grow over time. So we'll look at kind of the two outliers here. The first one being at the top, which is Chris, who invests $5,000 each year, and that's between age 25 and age 65. So that's a total investment of $200,000. And you can see there, that's a large investment. $200,000 is not a small amount to invest and to save on the side. But you can see there, starting early, age 25, and saving until age 65, that investment over time, at age 65, gets you over $1.1 million. Now, on the flip side there, and looking at the bottom, if we were to just start 10 years later, just a 10-year later window of saving from age 35 starting until age 65 ending. Now, we are investing less, so it's only $150,000 of total investment, which makes sense, taking 10 years off of that time frame. But you can see the dramatic decrease in retirement assets, comparing even that 10-year window at the beginning there of ending up with $1.1 million versus not starting until 10 years later, and we end up with $540,000. So it's starting early and saving consistently, no matter what, can typically lead to a higher savings than trying to start late and make up for that lost time in the long run. So cash flow planning, what we've talked about thus far with planning for your business and investment management, it's all great, but what Josh is going to talk about next in estate planning, these can be a real difference maker here. It's planning for the unexpected and planning for the expected as well. And also, he'll talk about it, but it's kind of guiding those funds while you're still alive and making sure that what you want to happen actually happens after you pass away.
Yeah, that's right. Thank you, Miller. Estate planning, I've said this for just about everything we've talked about today, but we could really talk for hours about estate planning and exactly what you want to have happen. But that's how the framework I would have you view this through is looking through the lens of what do I want to happen? Not what is going to happen, but what do I actually want to affect? And what do I want to have happen? So on the next slide, I'll give props to Miller for the great title here: Trust, Will, Power, Attorney. Oh my. But a trust, for those that don't know, you've probably heard of this, especially if you've had family go through someone that's passed away or have done planning around that. But a trust is just simply an unbundling of your right to control assets versus the right to enjoy them or the actual benefit of the assets. So think of a trust as, all right, I can appoint a trustee to control my money, and I can appoint my beneficiary to receive my money. That's it at a very basic level. I'll let you know it's far more complex than that, but we try to simplify where we can. But it's a great way to protect assets from creditors. One of the main benefits here is avoiding probate court. If done properly, we can minimize estate taxes. So just removing that from the public eye and not having any taxes like the going through probate could be, that's extremely important. But you can also specify exactly, hey, after I pass away or after my spouse and I pass away, what happens? And you can specify who gets to decide those things or who has to affect your decisions before and after you pass away. A will then is the kind of the old school. All right, this is going through probate. That means it's going through the court system. So that can be used to supplement a trust. We typically, if we're using a trust for anyone with sizable assets, we'll use what's called a pour over will, which any assets that we left out of the trust are poured over back into the trust by the pour over will. That goes through probate court. It becomes a matter of public record, and you don't get asset protection from creditors and subject to estate taxes. And in case you don't know, you're required to give public notice when you are going through probate that someone has passed away. So believe me, all the credit card companies and all the other creditors, they get notification that someone passes, and they'll be there to receive their money if there is any. On the next slide, some other really important estate planning documents: a power of attorney. They have a power of attorney for financial, which we call a general or durable financial power of attorney. This names someone to act on your behalf for financial matters. A general power of attorney is effective immediately, and a durable power of attorney takes effect upon the point that you become incapacitated. But either way, that ends when you pass away. So the trust is the only way that you could continue to have someone managing your affairs after you pass away. There's also things like a HIPAA release and authorization. You can see exactly what that does, naming a person to act on your behalf and requiring physicians to take that person's directions and to release health information. There's also a what people commonly call a living will, or a physician's directive, or directive to physicians, which is basically, all right, if I'm in a vegetative state, check here to say keep me alive as long as possible, or check here to let me go peacefully. So having those sorts of discussions and planning ahead of time can really help avoid some disastrous consequences later down the road. I'll hit on the next slide just briefly. This is, we only have a few minutes left, but this is just in general about beneficiary designations on retirement accounts. An eligible designated beneficiary, the most common one is your surviving spouse, but there are a couple of other categorical individuals that could fill that definition. But just know with the Secure Act and the Secure Act 2.0, they've defined what is an eligible designated beneficiary, what is a designated beneficiary, and what is not either of those. And that determines how quickly your beneficiaries have to withdraw your money and pay taxes. So it's extremely important to make sure not only the right individuals are listed in the right order, but just making sure that you have primary beneficiaries and contingent beneficiaries in case something happens to someone else before you pass away. An eligible designated beneficiary, that's kind of using their life expectancy to take the required minimum distributions. A designated beneficiary does not meet those definitions, so it's usually they have to take all of the money out within 10 years and pay all of those taxes out within 10 years. And then the last category, it's only 5 years. So that could impact the taxability to your heirs. So it's really important that we talk about those. The next slide here talks even more, like I just mentioned, what a primary beneficiary is, kind of that first person in line. A secondary beneficiary, all right, if that person predeceases me, then this next person gets my assets, and those can be on your retirement accounts or in your will or in your trust. But it's it's always important that those all coincide and that there's no contradictions, things that could cause issues later down the road. Just a couple other pieces of housekeeping: talking with your family about knowing where documents are, who's responsible for what, making sure the deeds are titled properly and that we're notifying Social Security if someone passes away, but also keeping record of who to contact, which hopefully for our clients, they know to contact us. We put all our information in their records. The last slide or two here just talks a little bit more about maximizing wealth transfers to the next generation. Right now you have $17,000 that you can give to anyone without reporting it to the IRS. If you're married, then you can both give $17,000 for a total of $34,000. But if you're giving assets between spouses, it's unlimited as long as you're U.S. citizens. And you can see there the exclusion for gift and federal estate taxes. So if your estate is less than 12.92 million and you're not married, it's likely that you probably won't pay taxes. But just know that number is a number that can change and will change as Congress updates laws. So implementing trust kind of helps shield us from some of those future tax law changes. And that's why we like using those so much. We have a couple things in here about different types of trusts. this one and on the next slide. But what I would just say is come to us if you really have these questions about what happens to my assets while I'm living, what happens to my assets after I pass away. There is 100% going to be a plan or some solution that works to accomplish what you'd like. And really, all these different kinds of trusts, they're all there to facilitate what your goals are. So we have a lot of tools in our tool belt. You just need to tell us exactly what you'd like, and we will help match you up with the right type of estate plan and the right type of financial plan overall. So, yeah, Miller, do you have any parting thoughts to share with everyone?
No, I appreciate your thoroughness there, Josh. I know, and we've said it, but hopefully in the near future we can really kind of get a series together to deep dive on these topics, because if any of this has jarred a memory or spurred an interest or just got you thinking, what we look at when it comes down to it for someone to do their holistic wealth planning themselves is will, skill, and time. And really, if any one of those three is lacking, then your plan is even more dramatically set up for failure. So what we try to do is coordinate all three of those so that not only is it successful, but it's easy for you, it's understandable, and you can spend time doing what you want to be doing and enjoying your retirement or whatever brings you energy. So, as Josh said, if any of these topics that we've touched on have spurred on some thoughts here, or made you really consider that maybe you're missing out on something, or not as protected as you should be, that is our area of expertise. And being part of LGT, we have a holistic planning team incorporated within our tax services, our business advisory services, like for those small businesses that we talked about, retirement planning and consulting. We like to have it all in-house because we felt, and our clients have felt, that is the most holistic and beneficial for them. And it's ultimately led to the most success along the way. So again, we appreciate y'all watching this webinar today. And again, if you have any questions or whatnot, our contact information is listed there. We'd be more than happy to have a conversation with you and get that ball rolling as far as getting your wealth management needs taken care of. So thanks again, and y'all have a great rest of your day.